Sup everyone, welcome back to the Idiot Investor Guide channel with your host Guy Davidson. Today it is Sharesies Ep.3. We've come so far in such a short space of time, and it's funny, I was talking to a friend the other day and we were just saying how much we've already changed our investment styles since we first started in March. And so there's a couple of things I'll go through today. First of all, I'm continuing to balance the barbell. And if you didn't see one of my previous videos, I was talking about balancing the barbell. So I'll go into that in a bit more detail, how I'm refining that. I'll talk about the auto investment that I've now set up to try and do a bit more of set and forget ETF investing, and just look overall at how the portfolio is performing and where I plan to take it in the coming months. As you all know very well by now, I'm not a financial advisor, don't even try and pretend to be. I'm just an average investor trying to make his way and get that financial freedom goal. So, don't take what I say as financial advice. You'd be a bigger idiot than me. As I've said before, go back and watch my videos. You would have seen this line before. But yes, just enjoy it, and hopefully it just gives you guys a bit of inspiration to get into investing yourself. And if you're already in investing, to give me some advice and help me out on my journey so that we can collaborate together. Actually, loving the community. Everyone's pretty friendly, and I've had some really sage advice from some people. So I appreciate that and keep it coming. So here we are, over $5,500 now, not bad. You can see I've got a bunch of that still sitting in my wallet, so I need to put that somewhere. I kind of like having a little bit of money in case something does come up, but I do really need to just actually put that somewhere invested so that it can start to be making gains, compounding interest. Up 17%, not too bad, almost $1,000 of returns, which is pretty awesome. I mean, I'm not going to get that sitting in a bank, so it's kind of cool to see. Over just a couple of months, I've almost made $1,000 off my Sharesies portfolio. And here we are. You can see I've been steadily investing over time, so I wouldn't say I'm exactly dollar cost averaging. I am in my ETFs, so I'm just chipping away at the ETFs and putting money in regularly each fortnight. With the other stuff, it's a little bit haphazard, but at least you can see that I'm consistently putting money into Sharesies every fortnight, which is as you should invest. You should be chipping away and putting money in regularly. Firstly, I'll go through the funds and the stocks and just sort of go through what I've changed there. And then I'll go and show you my auto invest and why I've set that up and what I've set it up to be. Jumping into the funds first, you can see that I've been chipping away at these and been increasingly investing into my funds because I'm really trying to balance out that barbell and have more on that sort of safe end of the barbell. So looking at your ETFs or bonds. I don't have any bonds, but I should maybe have some bonds. I have thought about it, and I was thinking that I might invest in bonds more as the market evens out again. So, as the share market goes back up again. This guy Zen Stiller gave me really sage advice on bond investing. He actually said that it's good to invest in the bonds when the market's going strong, and then when it flips on its head, you can take what you've made out of the bonds and put it into stocks, so you just rebalance your investment. So I thought that's a pretty good idea, and I'll probably do that in the longer term. But for now, the other bit of advice that Zen Stiller actually gave me was that the property fund is included in the NZ Top 50 fund, which I didn't realize. So I looked into it, and it is true. So everything that's in the NZ property fund is represented in the NZ Top 50 fund. So all of the property funds the property groups in New Zealand are actually in the top 50 New Zealand companies. So I've still got it at the moment because it's paying a dividend sort of middle of this month. So I just wanted to hold on to it until the dividend payment, and then I'll actually sell it, completely get rid of the property fund and rebalance that throughout my other funds. Because there's no point in having it. Basically, the only reason you'd want to have the property fund and the NZ Top 50 fund at the same time is if you wanted a heavier weighting towards the property side, which I'm not too phased about. They're both doing fairly similar in terms of percentage at the moment, and I just wanted a little bit of exposure to the property market. So the fact that it's already included in the NZ Top 50 fund, I'm pretty happy that that's giving me some of that exposure. Simplicity is key. I'm starting to decide, like, I always had the goal of having 5 stocks and 5 ETFs maximum in each platform. Less is better in my mind. Less is better. It's less complicated, and it's much easier just to have a handful of things that you're dealing with at a time. Onto my companies. So Air New Zealand doing really well for me. I invested a bit more in there, and you can see it's up almost 45%. So that's where majority of my gains are being driven from. Delegate is on the up and up. They're doing pretty well, 23%. And you can see that I'm selling my Seeker and Sky City shares. So this is basically what I was talking about when I'm rebalancing the barbell. I feel like I had too many investments in that middle area of the barbell, the sort of no-go zone. So to reiterate, and you can go back and watch my other video, I'll put a link to it below, where I actually detail what the barbell investment strategy is. But essentially it's, you want some safe investments. So when you're talking safe, it's in my mind relatively safe, so ETFs and if you want to go even safer, bonds and cash and so on. And then you want, at the other end, and at a smaller proportion, you want high risk, high reward positions. So the middle ground is sort of like high risk, medium, or low reward. And yeah, the way I've been thinking about it more recently is that I'm limping into a bunch of positions with not a significant amount of money, or not enough money that it would make a significant impact if it did suddenly take off. So that to me is pretty pointless. It's that middle ground where you don't get a huge reward, but you do risk losing it. So what I'm going to do moving forward, what I plan to do is actually invest more significant chunks, enough that I'm willing to lose it, because this end of the barbell, the low end of the barbell, that's high risk, high reward, which means that there's a high risk you could lose it all. So you've got to be prepared for that. You've got to be prepared to lose it all. And so you don't want to put so much money in there that you would actually be devastated if you lost it. So only play in that end with what you're happy to lose. But the payoff would be significant. So I'm going to be investing in the future in more high growth stocks that if they do come off, it'll be a really significant increase in impact to my portfolio. I thought TrueScreen might be one of those. I didn't do much research on it, to be fair. It's already up 12%, so I can't complain. But essentially they did a funding round where they offered 5-cent shares, and I thought, what a fucking bargain. I was like, you can't lose at that, 5 cents, man. If they went up to $1, that'd be significant. And I think the highest they've ever been up to was something like 30 cents. So even still, that would be a huge improvement, or a huge increase on a 5-cent share. But that's a complete gamble. But again, it's a gamble I was willing to take, $500. So I sort of just put it in there, have a gamble with it, and see if it comes off. If it doesn't, I'm not going to be completely devastated, and it won't be the end of the world if I do lose that position. So this is TrueScreen. This is the one that I randomly invested in. Well, when you look at it like that, it doesn't look like a great investment. We'll see how it comes off. I'm sticking with Air New Zealand because they still have a journey to go through to get back to full price, and I will end up probably 3 times or timesing my portfolio in New Zealand by 3 if they get back to their historical prices, and they pay a good dividend anyway. So I'll probably leave it until it gets to that point, and then maybe reinvest some of that money elsewhere. But I think I'll leave a bunch in there anyway for their dividend payout. Delegate Group, I just have a little bit of faith that it will come off. Again, this is dangerously looking like middle ground, because I'm limping in and the potential future growth probably isn't significant. So in saying that, it could be significant, but probably not as significant as some other stocks that I should be investing in if I want that high risk, really high reward portfolio. So anyway, that's where my companies are at right now. I'm going to hopefully only have 3 by the next update, unless I see a good option to dive in. But I think I'll mostly be investing in stocks in my US portfolio. So I'm currently using Stake and Hatch, and I've just put up a review video for the difference between investing through both of those. So go check that out. But essentially what I'm thinking is that the US market has much better high growth opportunity stocks. So that's where I'm going to be mostly doing my individual stock investment through. Finally, I'll just take you quickly through my auto investment order that I've set up. The reason I've set this up, I didn't in the past because I wanted to make investment an active activity. Like I wanted to actually have to transfer the money over and then put it into the different funds, because I want to be conscious of my investment. I want to be, very aware of where I'm investing, what I'm investing, and how that's going. I find that I'm looking at these apps pretty much every day, if not a couple times a day anyway. So I'm pretty aware of all of that. And I want to not have any excuses not to invest in these funds, because I think that's the important thing. I'm getting really good at dollar cost averaging into these funds. So I think that's sort of my safe, as I say, the safe end of the barbell bet, where I want to be constantly chipping into these funds, because over time I'd expect to see sort of 7 to 8% return on these. So that's sort of the safe nest egg side of things, and then I can play with a bit of money on the low end of the barbell or the risky end of the barbell. So the way I've set it up is that I've set it up to be US top 500, emerging markets, and NZ top 50. Sorry, US large growth. I chose large growth because I looked at the US 500 versus US large growth. There is slightly higher management fee in US large growth, but the gains overall over time look slightly higher in US large growth as well. So I'm just having a crack and hoping that will get me a slightly better return over time. I don't think it's hugely significantly different whether you chose the US large growth or the US 500. Emerging market fund I've just kind of chosen because a lot of smarter people than myself invest in it. I've had people give me advice one way and the other. So yeah, I'm still sort of tossing up whether I think that's the right thing to do or whether I've got my percentages right. So I'd be interested to hear your thoughts and opinions on how you invest in funds, what percentage you put in different funds and why, especially if you do invest in the emerging market fund. Why? Because if someone asked me, I would just say it's for hedging my bets. I don't even really know what's involved in the emerging markets. So yeah, I'm assuming it's like China and India and stuff, like markets like that do have that potential for really high growth in the future, and they're sort of taking over as powers. But hit me up. What's your advice? Let me know. Let me in. So I've selected those funds. I'm doing $400 a fortnight into the funds. So a large proportion of my investment does go straight into funds now. At the start, I put a bunch into individual stocks, but now I'm starting to try and be a bit more rational and put more of it into the safer option of ETFs. And I'll do it every fortnight. Putting 50% in US large growth and then 35% in NZ top 50. I just feel like the US has more potential for growth, and I believe they've done better over time. I think I had a look at that. But again, if you have a differing opinion on that, let me know. Drop a comment. And emerging markets, again, just hedging my bet. Should I have less of a percentage in here and more in top 50? What would your suggestion be on my auto investment? The key thing is that I just want to auto invest into these funds and keep dollar cost averaging. But yeah, your opinions are more than welcome. I'll just quickly show you. So with the US large growth fund, you can see over time I've been chipping away dollar cost averaging in. And I've been doing the same with most of my funds. That's my Sharesies portfolio number 3 update. We're doing pretty well. My investment style is changing completely month on month. So I think I'm refining. I'm feeling like I'm getting into a better, stronger position of understanding how I want to be investing long term. So I'm glad you guys can join me on the journey. And if you do have any advice or tips on investing and how I've been investing, love to hear them. Drop a comment, subscribe if you want to keep following this journey. I'll be doing my Hatch Portfolio 3 update very shortly, and be sure to look out for my Sharesies versus Hatch and Stake videos when Sharesies opens up to the US market. That'll be very exciting. I've also just released my Sharesies How to Invest $10 a Week journey. This is just so that we can prove that investment is for everyone, not just people with a lot of money. But even if you only have $5 or $10 a week or a month to invest, really worthwhile doing it, and Sharesies allows you to do that very easily. So check that video out if you're a new investor and you don't have a lot of money to invest, because I highly recommend that it's for everyone and everyone should get into it. Till next time, guys, we'll catch you on the channel. Have a good one.